Hello, students. This is Accounting 8442, and this is Chapter 1. Share my screen. Okay, so for Chapter 1, individual income taxes, we're going to go through what the introduction to taxation and understanding federal tax law is. Second, move this over here. All right, so the chapter objectives, we're going to talk about the importance of taxation and apply methods for studying this topic. We're going to describe the history and trends of the federal income tax function. We're going to apply good tax policies relevant to the tax system. What are the different types of taxes imposed, federal, state, and local level? We're going to talk about the administration of the tax law, which means how do we administer it? How do we make sure that the taxes are actually being paid and are being applied? We're going to talk about the audit process, not an audit where you are an auditor for a company and you're auditing the financial statements. This is the IRS coming to you and auditing your tax return and your books and records. So the audit process for the IRS, not like in generally accepted accounting principles or in intermediate accounting or accounting courses where there's auditors who look at our books and records for GAAP. This is for the IRS for tax. It's a little bit different. The ethical guidelines, economic, social, and equitable reasons for inclusion in a particular system. So all of these chapters, they start out with a big picture. The big picture is always talking about giving you a client's information. Okay, so picture yourself when you read the big picture, you're writing down the notes. So these are the notes coming out of a meeting, let's say, with Travis and Amy Carter. They're coming to you because they want you to do their tax return. So the big picture for every chapter is giving us somebody that's coming with their information for us to do their tax return, and they're giving us their information. So there's 5 pages worth of information, and we're going to use this information to give them answers as to how they should do their tax return, or how should they structure the way they do their business to make sure that they're going to benefit by having lower taxes. So some people might say, well, you're supposed to pay the taxes you're supposed to pay, but there's IRS rules and laws out there about what and how do you do your taxes, and how do you structure your businesses, and how do you structure your transactions. And the way you structure your transactions is going to help you to have lower taxes. They're there for a reason. So you want to make sure you're planning to do that, so your business is paying the least amount of taxes as it should. So I wanted to go through real quick. Let's go back to our Blackboard page, right? So in our Blackboard page, underneath course materials, you're going to find this video that is where you got it from here. But these are all the PowerPoint slides, and then the Excel files are going to be put here after I create them, right? So the PowerPoint deck is what we're looking at right now. Those are all saved right here. The Excel file that I've created right here, I'm going to make it bigger so you can see it, but I just want you to go through what we're going to go. I'm going to show you what we're going to go through. We're going to talk about social economic reasons for tax breaks in this example here. We're going to talk about business tax versus regular business tax, which is a review of your chapter 18 of, I think it's 18 now, of 335. I think it changed from 2019, chapter 19. We're going to talk about the levels of tax rates that are in place now for 2024. We're going to do a calculation to show how do you come up with your tax rate. And then there's going to be 2 separate ones here for you to do on your own. Then we're going to go over the different types of taxes like sales and use tax and estate tax, inheritance tax. We're going to talk about payroll taxes, and we're going to talk about gift taxes. So this is kind of walking us through the high level of what we're going to go through for this class. So Travis and Amy Carter are married and have 2 children. April's age 17 and Martin's age 18. Travis is a mining engineer and Amy is a registered nurse. So they're sitting across picture them sitting across the table from you, and you're writing down these notes after you ask them all these questions, because you need to know this information to be able to do their tax return. After several years with the mining company, which means he's an employee, Travis established a consulting practice, which means he's there, and the consulting practice, he's an independent contractor. So here he's an employee, which we double check by asking him, and here is he's an independent contractor, which is also could be an employee from his own consulting practice. And he has a lot of travel. The Carters live a few blocks away from Amy Carter's parents, Ernest and Mary. The Walkers are retired and live on interest, dividends, and Social Security benefits. So here's an example of another set of facts. We're not only just talking about Travis and Amy Carter's facts, we're also talking about Amy Carter's parents' facts. So there's 2 sets of people here that we're looking at how to do their tax return or how to answer questions that they might have. So here's the things that have happened during the year that might give them tax ramifications. A ramification means that based on this type of transaction, you're going to have to pay tax on it or not. The property taxes, or ad valorem taxes, that's the Latin word, property taxes. So you own a building, or you own a house, or you own an apartment. You have to pay property taxes on that. The Carters, Travis and Amy, have their taxes on their property increased. We're going to talk about why would they be increased? What would make them be increased? So all of these things, you should be writing these down, because you need to know what will increase property taxes. The Walkers, who's Amy's parents, their taxes decreased. Well, what are things that can decrease your property taxes? We're going to go over those. Travis registered an automobile purchased last year in another state. He's required to pay sales tax in his home state. We'll talk about what that means under sales and use tax. Other developments that occurred. As an anniversary present, the Carters gave Amy's parents, the Walkers, an RV. That's one of those those big recreational vehicles, is like a mobile home type of thing. Also, Travis employs his children to draft blueprints and prepare scale models for the use in his work. That's probably from his consulting practice as an engineer, right? Both April and Martin have had training in drafting and typography. The Carters were audited by the state and income tax group, state and income tax return. So the state audited the Carters. Later in the same year, they were also audited by the IRS. And that happens a lot of times, where if the state audits you, the IRS will follow suit, or the other way around. In each case, a tax deficiency was found. Deficiency means you don't have enough of. Like if you're deficient in iron, it means you need more iron in your body, so you have to take iron pills. So deficiency means in each case, the auditor said you were deficient. You didn't pay enough taxes. You're supposed to pay more taxes. So what happens is, when you file your tax return, let's pretend you filed your tax return in 2023, and you were supposed to pay $1,000, but you only paid $900. When they audit you and they say, hey, you only paid $900, but you're supposed to pay $100, that is the tax deficiency. You're supposed to pay $1,000, but you only paid $900. The deficiency is $100. Now, interest is, well, the IRS was supposed to get that money in 2024 when you filed your tax return for 2023. Your 2023 tax return has to be filed in April of 2024. So what happens is the IRS didn't receive that money in 2024, but if they had, they would have put it into the bank and earned interest. So what happens is, because they didn't get that interest, now they're going to charge you for that interest that they didn't get. So you have to pay the $100 plus the interest. So that's what that's saying, that the IRS said that they were deficient and had to pay the taxes and interest. The Walkers, Amy's parents, also were audited by the IRS, but they just really got a letter by the mail. So we're going to talk about in the back of the chapter in detail what types of audits they are and what these all mean. Okay, so read the chapter and formulate your response. So there's 5 pages of the big picture, and they've got questions about all of these things, right? So first, we're going to talk about how do you approach the study of taxation. Taxation is, I'm going to make this bigger so you can see it. You must use flashcards or write notes to get the information into your head. It is law, and there's a lot of law that you're going to be learning, okay? When you did accounting, accounting is generally accepted accounting principles. It's not law. It's a generally accepted accounting principles, which is when you are an accountant, you follow those principles. And then as a CPA, you follow ethics, and you should be following those principles. But for the IRS, it's law. The law is just like any other law in the land. It's created by a bill, by a congressman or whatever. The bill then goes to the floor, and then it's voted on, Senate, and then the representatives. They then say yes or no. Then it goes to the president of the United States, and then the president says yes or no or vetoes it. It's a law. So you have to pay your taxes following the law. Okay? So the study of taxation is, what is taxation? It's 2 famous quotes. Taxes are what we pay for a civilized society. Where do your state taxes and federal taxes go? Your federal taxes go to let's say state taxes. Your state taxes go to paying people who work for the DMV, people who work in the court system, people who work as rangers out in the forest, people who work in the parks. So there's all of these federal and state departments, and those departments are paid by our taxes. So we're paying our taxes for a civilized society. Federal taxes also pay for the Army, Navy, Air Force, Army, Navy, Air Force, and Marines. The other thing is, nothing is certain except for death and taxes. You have to pay your taxes because it's a law. Taxes are what the government uses as revenue so that they can then spend that money in the way that they're elected to do, okay? We're not going to get into politics about what and how it should be spent, et cetera, et cetera. It's just what taxes are is for the government to be using our money to do the things that are needed to be done across the land, across the state, across the city, to have society keep going. It can also be influenced for behavior. Okay, so my little example here is Amazon. Amazon wanted to open up a location in Brooklyn a few years ago. And let's say that this location, which is a warehouse distribution center, was going to bring in $10 million. So the governor of New York worked with Amazon to say, yes, we want you to come to open up in Brooklyn. And then Amazon is kind of saying, all right, well, we have to pay the federal taxes, which federal taxes are different than individual taxes. This is how we figure out individual taxes, which we're going to get to. But federal taxes for business is 21%. Okay. New York State's 10% and New York City's 5%. I'm just making those up. I'm not really sure what those are. I'm just going to talk about federal. So Amazon says, yes, we want to come to Brooklyn as well, but what kind of deal can you give us? What kind of deal can you give us? So the governor will make a deal and say, okay, for the first 5 years of you living in New York or having your business in New York, you won't have to pay the 10% of taxes. You only have to pay 5% for the first 5 years. So instead of paying $1 million to New York State, which is 10 million times 10% is $1 million each year, they're going to only pay $500,000 each year. And some people will say, well, wait a second, we're going to lose $500,000 of revenue. Well, the other thing is, if you don't have the 10 million coming into Brooklyn, you're not going to get any of this. You're not going to get any of this either, right? So the idea in these business transactions is influence the behavior of individuals or businesses. We want to influence the behavior of the business. We want to influence the behavior of Amazon, that they will come and open up their warehouse. So Amazon was all for it. The governor of New York was all for it. And the other deal was New York City, because Brooklyn is New York City. The governor said that we'll give you a 2.5% to New York City for 5 years versus 5%. So basically there's a $750,000 savings, because if it was normal 21, 10, and 5, it'd be one, well, for the state and city, it would be 1.5, but they're only going to get half of 750. So that's an example of wanting to bring businesses into the thing, into your location. And that's what they're trying to explain with this influence behavior. Now, the deal fell through because Brooklyn, the neighbors and people that lived in Brooklyn where that Amazon site was going to be put up, vetoed, did lots of, what do you call those things? Picket lines and stuff, because it was a small little neighborhood, and there was going to be trucks coming back and forth. And the neighborhood basically came to the meeting with Amazon and said, are you going to pay for the repaving of the roads in and out of this area? Are you going to pay for this and pay for this and pay for this and pay for this? And Amazon said, no, our taxes that we pay to you will be taking care of that. And it was going to be an eyesore, and they were very unhappy with it. And basically what happened was that it never went through. And now that area is a park in Brooklyn. So that's an example of influence the behavior. Okay. So the relevant areas of accounting and finance professionals for taxation. I don't care if you're going to be an accountant or a marketing person or working in computer science, or you're going to be working in healthcare. You have to know how the transactions that you do as a manager in the offices, how the transactions that you're creating are going to be taxed. Because if you just change the way a transaction is made, you can change the taxation a lot. So an example is, I had a client effect on planning and transactions. So I had a client that made a deal to purchase construction equipment from someone. And the contract basically said, IXYZ company will purchase all of the construction equipment from ABC Co. for $1 million. This is a true story, right? That's all it basically said, okay? That's the main crux of it, okay? Well, what happened was, a few months later, the client got a bill for New York State sales tax for $1 million times 0.08875, because that's the sales tax rate in New York. For $88,750. That was what the bill was for. Got a bill from New York State for sales tax for $88,750. You might be like, all right, so how could we have changed that? What would be effective planning or your transactions, right? So if you're someone in the medical field and you go and you buy some medical equipment and you don't do the transaction correctly, or you put the contract correctly, then you might get this bill. So what do you think the fix is? Right? Pause this video and think about it. What do you think the fix is? How could that contract, that wording have changed? So he came to me livid. How did this happen? Why did you let this happen? And I said, you never even showed me this contract. I didn't even know this was going on. Why didn't you? I've told you time and time again to show me your contracts. I'm in the finance department. He's in the purchasing department. He was in the, sales department. Nothing to do with me. I said, stop doing contracts without letting me see it. So I said, show me the contract. And then he showed me this contract. And then I said, this was the fix. XYZ company, right? Just going to for $1 million, including sales tax. So everything's the same. Put this little comma there, that's correct. I'll take the I out, right? XYZ company. The I looks funny to me. That's how it was written, but I'll take it out. Everything's the same. The only thing that's different was me putting including sales tax. If he put this amount in there, the words including sales tax in there, he would not have to pay. His sales tax bill would have been $0. Okay? So no matter where you are, no matter what you're doing, no matter what division you're in, you need to know, this is just an example of sales tax, okay? But you need to know what your contract is doing because it will affect taxes. Okay. So compliance, that is doing tax returns. Planning, that's working with departments to say, how are you putting your contracts together? So this exact same client that I worked with, when I first went to their company, I went through all their contracts. I went through every department's contracts and fixed them and changed them. I went through all of their processes to change the way that they're doing their business so that it would be more tax advantage. And all of that happening and all their invoicing and everything that I did saved so much in taxes because I planned the way the company ran and the way the transactions happened to follow the cheapest tax route that there could be, which is the best you can do for your client, okay? Financial reporting. So the way it works is you do your generally accepted accounting principles, you do your debits and credits, you do your transactions, you do your financial reporting, then you bring it over to your tax return, and then you do your IRS, your GAAP to tax differences, which you learned in chapter 18, GAAP to tax differences. There's also environmental, social, and governance reporting, where if your business is an environmental business or a social business, usually these are not-for-profit businesses, they still have to report all of their income and their expenses, but they don't necessarily have to pay any taxes, but they still have to report like they're doing a tax return. Controversy, that's what we're going to get to when we talk about audits. Well, a controversy is, I would help a client where they got an audit letter, and then they got an audit letter that said that they owe $1 million. Well, then I would go back and look at the facts and look at the transaction and look at the paperwork. And then I would fight the controversy if I believed that the IRS was wrong. So in all of these are different types of positions that you could have in the tax world, where you do tax returns, or you help clients to plan, or you do financial reporting so that it matches up with the IRS, or you do reporting for these groups, or you help clients. All you do is help clients with controversy, that they come with you because you're able to work with the IRS. How do you manage your cash? How are you investing your cash so that you are having a tax benefit? Data analysis is new on the CPA exam. So data analysis is taking the information that has happened throughout the whole year, analyzing the data, putting it into different types of reports based on what kind of company needs reports from you. And tax advocacy, an example of that would be a lot of CPA firms and CPAs, when they're working with clients, they also will take on pro bono cases, for example, where they will help to advocate for someone who doesn't have enough money to pay for a CPA, and they've got an issue with the IRS, so they've got a problem that they haven't paid their taxes because they didn't even know to pay their taxes. And I would work as an advocate on behalf of that person to help them get out of that tax debt. So how do you study taxation? Your goal is to recognize the issue or the transaction. For example, this was an issue. This was the transaction, and this was the issue. All of the information that is in this big picture is giving us issues. And then we want to recognize what is the issue or transaction that our client has across the table from us. Then I want to do the research to find out what's the best tax law that we can apply to this situation to have the least amount of taxes paid. Okay? You have to know the rules. You have to know the tax rules. Okay? What tax rules are applicable? Why they're designed in a particular way? When are they relevant? And how new rules will affect a client or their employer. I might have a client that's been following rule number IRC code 32 AE1579. But then now that changed, and that a new law came in and revamped that. And I'm like, you know what? That's no longer good for you. I need to change the way that we're doing your transaction, change the way your contract written, is because there's new rules that are going to affect you. So individuals and taxes. So when you are working with an individual to help them do their taxes, it's important to understand the individuals in the center of this circle here. Then you've got the purple here to find out about the person and themselves. Then each of these layers are talking about these people themselves, right? So if I'm talking about it with an individual, I want to get to know the person. What are their personal responsibilities? So I'm sitting across from a client and I've never met them before, and they want me to do their taxes. I need to know, what are they personally responsible for? Maybe they have a mother that they're taking care of, or maybe they've got children that they're taking care of, or maybe they have a disabled spouse that they're taking care of. What are their personal responsibilities? What about their financial literacy? I have 3 sisters. 3 of us are in the accounting world. My other sister is not. She's more artistic. She's someone who has absolutely no financial literacy whatsoever. She basically takes a credit card, goes shopping, and doesn't think about the money because she doesn't see the money. Years ago, she got into a lot of debt because she didn't have any financial literacy. She didn't understand how it worked, that we actually had to get together to help her to pay off her debt and then teach her how to manage her money and realize that a card is actually money. So depending on who you're talking to across the table from you, you might have to speak differently to each person i.e., let's say to quote unquote dumb it down to a person who's not financially literate, or use examples that would be easy for them to understand, or someone who is financially literate, you don't have to do that. And their civic responsibilities. Maybe they're part of, maybe they're a public official, or maybe they are working in some capacity to help with some kind of not-for-profit in the area. Just getting to know the person. The next layer of knowing them is, what kind of business are they in? Do they have their own side business, or are they an employee, which is on the other side, or are they both? You can be an employee and have a side business. Do they invest their money, or do they just have a savings account, which is still investing their money, but or do they have a huge portfolio of stocks and bonds with a broker? Personal and consumer, where do they spend their money? Do they spend their money on retail, like they buy lots of clothes and buy cars and watches and things like that, which are really liabilities? Or do they buy assets? Do they buy houses and apartments and things like that that they're going to use as a side business? You need to know all about the person. And then from there, you'll do their tax returns. You'll do their tax planning. How are we going to structure the way that they have their life with their children, or their businesses, or their investments? We have to plan how we want to structure their transactions. Then we want to do their tax returns. And then if there's any problem, we will be their advocate for them if there's any tax controversy with the IRS. So here's a knowledge check. Which of the following is not a direct tax? Which we haven't even talked about yet. Personal income tax, property tax, corporate income tax, or sales tax. Personal income tax is what comes out of your check when your boss takes money out of your check, right? That's your personal income tax. And you file your personal income tax returns at the end of the year. Property tax is tax that you pay based on the value of your property, generally your home or apartment. Corporate income tax is what I described like Amazon, and we're going to talk about these in more detail next, where you pay taxes on your income that you earned as a corporation. So personal income tax is directly affected by your income. Property tax is a direct tax from your property. Corporate income tax is a direct tax about your income. Sales tax is the answer. Sales tax is not a direct tax. It's called an indirect tax because you don't pay that directly to the state. You will go to the store and you'll buy something, and it's paid to the government by the person who pays the tax. That the direct tax would be you pay the IRS, et cetera, directly, or your employer does, right? Indirect taxes are sales tax, for example, where when you purchase goods such as clothes, you will pay the sales tax to the company like Kohl's or Walmart or whatever. Kohl's and Walmart will then turn around and pay the sales tax to the government. So here's an example here. Let's say you go to New Jersey, sales and use tax. Let's say you go to New Jersey and you buy a sweater. And in New Jersey, there is no sales tax rate. And then you come back to New York, right? And you buy a sweater in Yonkers, and it's $100. Well, there's a tax rate of 8.875%. You're going to pay $108.88. That's going to be your bill, $100.88. $108.88, the two together. Right? Well, the $100 goes to the store that you paid the $100 to. The $8.88 also goes to the store, but the store will turn around and put that on their monthly state sales tax return. So Kohl's, let's say you went to Kohl's, your Kohl's journal entry will, they received $100, $108.88 from you. It's a sale of $100 to Kohl's, and it's sales tax payable of $8.88. And then they'll have to do a debit to sales tax payable and credit cash when they pay the sales tax to the state. That's why it's called an indirect tax. A brief history of taxation. I'm not going to go through this with you. You can go through this. This is history. You can read it, understand it, read what they are, other important events. Individual, I'm going to go through that. There's more detail in the book. I want you to go through all that detail, but it's about you just reading and understanding the history. I want you to know here that the revenue that's collected for taxes, 51% of it is collected by individuals from your individual income tax returns. Corporate income tax only is 10% of the revenue that the federal government collects, only 10%. Individuals like you and I are 51%. Payroll taxes, 34%. Now, when we talk about payroll taxes, part of those come out of half of that, so 16%, let's say, is also coming out of your pocket. So 51 plus 16 is coming out of your pocket. The other half of the payroll taxes is coming out of your employer's pocket. And I'll explain that to you. And ex-state taxes is 100%. That's where the revenue comes from. Major source of revenue for the federal government. What's your guess? Income taxes. All right. So the tax system design. You can read about this. This is how, this is also more history. It's in the book. The tax base versus the tax rate, proportional or progressive, okay? It's proportional or progressive. So if you go and you have income, that will be your tax base, whatever's taxable. Multiplied by your tax rate equals tax liability is really not actually correct. It's tax rate on a progressive scale. So here's the example. Here I gave you the business tax, a review of Chapter 18. GAAP, you had revenue of 500, expenses of 300, 500 minus 300 is 200,000. So 200 times 21% is 42. So 200 minus 42 is 158. That was on your GAAP financial statements. But for tax purposes, they're saying of the $500 worth of GAAP revenue, only 350,000 of that revenue is taxable this year. So 150,000 of it is not taxable this year. So for your tax return, you're only paying $10,500 because 350 minus 300 is 50. So that you're paying $10,500 of taxes. That's what your current piece is. Your total amount is $42,000, but you're only paying $10,500 of it now. The rest of it is going to be deferred. So if you don't remember this, go back to Chapter 18, Accounting 335. This is for your business tax, and this is your deferral, right? This is your total amount because that 500 is going to be taxed either this year or later on. 350 will be taxed this year, current. The rest of it will be taxed later, so it's deferred. Okay, that's a review of Chapter 18. So these are the tax rates for 2024. You as an individual, okay? So the way that it works is, let's say I made $165,000 this year. How is that taxed? Well, the first $11,600 10% is taxed at 10%. So 10% for income for individuals, single individuals with income of 11,600 or less. If you're married, filing jointly, it's different. If it's married, filing separately, it's different. If it's head of household, it's different. So if you go to a Form 1040, this is 2023, because the 2024 are not out yet. So these numbers will be different. But there's single or married filing separately, which is your category. Let me put it up here. Single, married filing jointly, married filing separately, head of household, or qualifying surviving spouse. So I'm showing you here individual, single, and married. But there's also married filing separately, head of household, and qualifying surviving spouse. Their amounts, their calculations are different numbers. So how does this levels of taxation work? When you're being taxed, it's based on equity. Equity. That everybody's taxed equally across the board. And you might think, well, it's not fair because richer people are getting taxed at a different rate, blah, blah. It's equity. And this scaling or progressiveness is making it equal. Because let's say one of you is got a part-time job and you make $11,000, okay? Your $11,000 is going to be taxed at 10%, because anything that you've earned 11,600 or less is going to be taxed at 10%. So while I'm making 165 is in this bracket between 100 and 191, which is 24%. So should I be taxed my whole 165, taxed at 24%, and make me pay 39,600? Well, then I can argue and say, well, wait a second. My first 11,600 should be taxed at 10% like everybody else's. Why is my first 11,600 being taxed at 24? Because if I was taxed at 165 times 24, then my whole 165 is being taxed at 24%. But your 11,600 only be taxed at 10%. That's not fair. So that's why they created these levels. So my first 11,600 is taxed at 10%. Okay? So that's taxed at 10%. So everything from 11,601 to 47,150 is taxed at 12%. So my next level of money is taxed at 12%. So I'm going to do 47,150 minus the 11,600 I was already taxed. I'm not going to get taxed at 11,600 again. So the next 35,550. So if you look at that, 47,150 is the total. That's the 47,150. So my first 47,150, part of it's taxed at 10% and part of it's taxed at 12%. So I do this 35 times 12%. So now so far I've got 5,426. So my next layer of money, because people who are making, let's say $100,000, they're getting taxed at 22% from 47,000 to 100. They're going to be taxed at 22%. Why should I be taxed at 24 for that whole amount? So I'm going to say my 100,000, 525 minus the 47,150 that I've already been taxed on is my next layer, equals this times this. So that's my 105.25. So my first 11,600 is taxed at 10. My second layer, anything from 11,601 to 47,150, which is $35,000, is taxed at 12%. I add these three up, it's 100,525. So up to the 5, but I'm actually getting taxed at 165. So I have to go to another layer. But this time, my 165 is the total amount that I'm being taxed. So do I do equals the 191,950 minus the 100,525 that I've already been taxed? Well, no. Why am I going to get taxed myself on 91,000? I only earned 165. So when you get to the bracket, that's the amount. That's what you tax. That's what you stop on. I'm in the range between 100 and 191 because I'm 165, but I only will do 165 minus the 105.25 that was already taxed. So all of this that's being taxed is my 165 because this is the sum of these, right? The sum of these. So my 165 is broken out into these layers. My first 11,600 is taxed at 10%. My 35.5 is taxed at 12. 53.3 is taxed at 22, and 64 is taxed at that. So if I did 165 times 24%, my tax would be 39,600, which is not correct because we do it in layers. So my actual tax is 32,643. So doing it the correct way, I'm actually saving $6,958. So this Excel file is going to be saved. Again, it's going to be saved here in Blackboard in this Excel file. And what I've done is I've left two. 550 is the income, and 13,750 is the 136,750 is another one. And I want you to do this yourself. I want you to practice it so that you understand it and you just follow along with this. And now remember, the 165 or the 550, you have to go to 550, you have to go into this 243 because the 550 is in this range. The 136 is in this range. But it's not going to be 165 minus 100,525. It's going to be 136 minus 100,525. So you can do that on your own. And then when you've done it, you can email me if you want to, and I can send you the answer. So that's where the equity comes in, is that everybody's 11,600 is taxed at 10%. Everybody's 11,601 to 47,150 or their 35.5 is taxed at 12%. Everyone's amount between 47 and 100, which is 53,000, is taxed at 22%. Versus my whole 165 being taxed at 24%, it's being taxed in layers, and that's where the equity comes in. Certainty means we're definitely going to get paid our taxes. How come? Because your employer takes it out of your check and sends it in. That's the convenience of payment as well. It's certain that it's going to happen, and it's convenience that your employer is sending it in, not you. So these are guiding principles of good tax policy. I'm not going to go over all of these in class. You need to read these. What is equity and fairness? What are the guiding principles of equity and fairness? What are the guiding principles of certainty? What's the guiding principles of inconvenience of payment? You can read these. There are going to be questions on your exam asking you about these. And there's a knowledge check question that you can answer. Types of taxes. These are the different types of taxes. Property taxes or ad valorem taxes. So like I did some examples in this file, right? We've already done income taxes for a business. We've already done, this is the business taxes, right? This is also the business tax review. This is individual income taxes. The sales and use tax we've already done. The other ones are estate inheritance taxes and property taxes. And these are the payroll taxes, which we're going to get to as well. Okay. So property taxes is based on the value of your property. It's a very simple thing. if your value of your property is $350,000 and the property tax for your area is 5%, it's 350 times 5%, and you paid into the state. Transaction taxes are VAT taxes or sales taxes. They're indirect taxes. Transaction, it's based on the transaction, the sale. So sales tax and use tax are transaction taxes. Taxes on transfer of death, those are inheritance taxes. Gift taxes, you give a gift of money, you who give the gift pay the taxes on it, not the person receiving it. Income taxes are the taxes that you pay on the income that you earn. Employment taxes, that's what your employer, which when I get over to here to payroll taxes, these are payroll taxes. Employer tax and payroll, this is payroll taxes. We're going to get to the employer side in a minute. Other taxes and proposed taxes. This is the rest of the chapter. No, this rest of this section. Property taxes based on the value. Okay, it's basically on land or buildings, resident office, personality, home furnishings, blah, blah. Each state has their own rules about what's taxed and at what rate, and they're deductible for federal income tax purposes. So on your tax return here, there's a standard and itemized deduction, Schedule A. Always go to the irs.gov when you're pulling something up, irs.gov. So here's a Schedule A, itemized deduction, which we're going to go through this semester. So taxes that you've paid, real estate taxes, personal property taxes, local income taxes or sales taxes. This itemized deduction sheet, these are deductions that will flow through to your page 1. This deduction, if your adjusted gross income is, let's say, $100,000, and your Schedule A, let's say you've got $10,000 here. Let's say you have $7,000 here. Let's say your home mortgage interest, which is something else, it's deduction. Let's say it's $20,000 here. Gifts to charity, let's say is $5,000, which we're going to learn how these all work. So we add this up. We've got $17,000, $37,000, 37 and 5. I don't know how to add. There's 7 to 8, 37 to 39, 44, and 42. So this total equals $42,000. That comes over to here, $42,000. So, and then we'll talk about this later. So your total for these two lines is $42,000. So would you rather pay taxes on $100,000 or 100 minus 42? $58,000. Would you like to pay taxes on 100,000 or 58,000? So the standard deduction, when they say deductible for federal income tax purposes, your property taxes, which are on your Schedule A, real estate taxes, personal property taxes, they are a deduction that come over to your first page. So ad valorem property taxes, back to the big picture. Why did the Walkers' taxes decrease, but the Carters increase? So think about you own a house, okay, or you own property. If you own, let's say, an apartment, if you increase the value of that apartment, maybe, for example, you had one bedroom, you had 2 bedrooms and 1 bathroom, but there was a big area on the other side by the second bedroom where you could put a small bathroom with like a sink and a toilet. You've now just increased the value of the apartment. So if the Carters increase, it probably means that they've done something to the apartment or the house. Maybe they own a house and they built a new deck, or they put in an in-ground pool. That would increase the value of the house. When the value of the house goes up, your taxes go up. So another example is over here, I talked about filing status. And let's say you're married filing jointly and you're older people. If you were born over here before January 2nd, 1959 in 2003, you get what they call, right here, we talked about the itemized deduction, which again, we're going to go through this in detail. But let's say you don't have an itemized deduction because you don't have medical expenses and you don't have a lot of property taxes. You only have, like, let's say $5,000 worth of this, and you don't have an interest loan, and you don't have charity. And so your amount here is really just $5,000. Your standard deduction, you can either on this line take your itemized deduction to $42,000, or if you're single or married filing jointly, $27,700. Which one would you rather, $42,000 or $27,700? I'd rather $42,000 because it makes me have less taxes. But if you have a situation where you are older and blind, you get extra deductions on top of this. So what they're saying is, if the Walkers achieve senior citizen status, where they now are born before this time, they get an extra standard deduction, but it also affects their property taxes. So if you go and you're older than a certain age, the state you pay your property taxes, and then they will give you a deduction because you reached that status. So that means their property taxes go down. For the Carters, their property went up. It's because they made significant improvements, maybe a bathroom renovation, addition of a deck. Oh, same thing that I said. Okay. Transaction taxes, federal excise tax, state and local excise tax. So the federal government rules and the state and local rules are normally different. Sometimes they're the same, sometimes they're different. General sales tax, which is sales and use tax when you go to the store, which we already went through that example, and severance taxes. We're going to go through those quickly because you can read those. Federal excise tax. Excise means extra. Tobacco products, fuel and gasoline, air travel. Okay. There's all these excise taxes. They're excess. They're imposed at the federal level. And there's specific examples. Okay. There's an excise tax on trucks and trailers. And that excise tax is to say trucks on the highway are causing, damage to the highway. So we're going to charge them an excise tax, whatever. So there's also an excise tax on corporations buying back its own stock. There's also alcohol taxes. There's miscellaneous taxes on wagering, tax on investment. They're all different depending on the state and city and the federal. That's an excise tax. State and local excise taxes are the same idea. Okay. There's hotel occupancy, rental surcharge. These are all different examples, and you can read more examples in the books. General sales tax. I already gave you the example of sales tax with the here. Now, what I did over here was, if you went to New Jersey and bought a sweater, but you live in Yonkers, over here on your tax return, on your schedule, cancel. On your Schedule A, it says state and local income taxes or general sales tax. You could put that there as a deduction. So what they're saying here, what I put over here in this Excel file is, if you went to New Jersey and you bought a sweater, but New Jersey doesn't have a tax rate. They don't have a sales tax rate for clothing. I mean, I don't know if they still do anymore, but they used to not. If you bought that sweater in New Jersey, okay, but then you brought it back to Yonkers and live in New York and used it, sales and use tax, and used it in Yonkers, technically, you're supposed to put that $100 on your tax return, and you're supposed to pay the tax, put that on your New York State return, because technically you bought that sweater in a state that doesn't charge sales tax, but you're using it in a state that does charge sales tax. So you're supposed to put that on your New York State tax return, which is the law. General sales tax. There are some states without sales tax: Alaska, Delaware, Montana, New Hampshire, and Oregon. They don't even charge any sales tax. They just have different types of taxes. So each state is different depending on how they are going to tax you. So back to the big picture. Travis had that car. So he purchased it in another state that has no sales tax, probably, because it said he had to pay the sales tax in his home state. Same idea. If you buy a car in Florida that they don't, in one of those states that doesn't have sales tax, and you come and bring it to New York and you go to the DMV to register that car, they're going to say, you got to pay us the sales tax because you have to show that you paid sales tax on the car. Severance taxes. That's not like I lost my job and they're giving me severance. That's not what this is about. Severance is you're severing. Like if you think about you cut something, you're severing it, a severed head, right? Or you take a melon and you cut it, you're severing it. You're basically cutting natural resources from the earth. You're taking oil from, you're severing it from the earth. You're taking gas, you're severing it from the earth, iron, ore, and coal. So there's a tax when you take that from the ground, you're paying a tax on that. That's what severance taxes is, and they're a complicated tax return. Transfers on death. Those are taxes when someone dies. There's a tax on the right to transfer the property or to receive the property on the death of an owner. Okay, if it's imposed on the right to pass, it's an estate tax. If it's imposed on the right to receive from the decedent, it's inheritance. So what does that mean? Let's say I'm the person and I die and you are receiving my assets. Let's say I have a house. I own a house and then I die, but I have you in my will that you're going to receive my house. I am the person, the property at death. It's an estate tax for me. You receiving the property is an inheritance tax. Okay? The person who's passing or dying, it's the estate tax. The person receiving the property is the inheritance tax. The value of the property, we're going to go over this in detail, is different depending on if you got it as an estate, inheritance, or because the federal government only has an estate tax, right? You as a person receiving property from me, you receive my house. There's no federal inheritance tax. There's no inheritance tax for the federal government. There is, however, a state inheritance tax, depending on the state. Some don't. Some state governments have neither. Example is Florida and Texas. Florida and Texas don't have an income tax, an estate tax, or a inheritance tax. Okay? So each state is different and how they do it is different. But we're just basically, I'm telling you all the different types of taxes that are out there. We're not in the detail of how they all work. Federal estate taxes on the right, so that the gross estate includes property of the decedent at the time of death. So I'm the decedent. I'm the one who died. I own a house. I own a car. I own a bunch of stocks and bonds. I own money in a mutual fund. That's all my property. Okay. Life insurance proceeds, et cetera, et cetera. That's my property. That is going to be then passed to you because you are in my will. Right? The value of the estate, well, what's the value of that house? When do we take that value? The value is on the date of my death. Or my lawyer could say 6 months later. The date of death, what's the value of the house on the date of my death? Or 6 months later. And the reason why they pick that is they want to pick the one that's going to say the value of the house that's less. Okay. Or more, it depends on the situation. There's also deductions on my estate tax. So I have the value of all my property on the state tax minus my expenses, my funeral expenses, debts that I have to pay. I maybe have a credit card debt, all these things that have to come out. That goes on the estate tax return. And there's other deductions. Now, you might be saying, well, oh my goodness, what if I don't have what if I die and I have nothing and I don't have any money? How am I going to pay this? Well, there's a unified tax credit. And what it's saying is that the only people who really have to pay taxes on their estate is if the value of their estate, the car, the house, the money in the stocks and bonds and whatever, if you add all that up, minus all those expenses, minus all this stuff, and you add it all up, and the amount is less than $13,610,000, you don't pay any estate tax. It's only for any amount for $13,610,001 and above. So if the value of your estate is $13,610,001, you're going to pay taxes on that dollar. And anything above that, you're going to be taxed on that. Okay. State taxes, same idea. You can read that. It's different. The federal gift tax. Okay. There's 3 slides to this. There's credits for them too. Okay. This is that 13,610. 2023, it was 19,290. This 13,610 is coming from this unified tax, unified estate tax. Where I just lost it. Here. That unified transfer tax credit, 13,610. So federal gift tax. I can give you a gift. Okay. If I give you a gift, part of that gift is taxable. To me, I have to pay the tax. So let's say I want to give you a gift. I can give you a gift of $18,000. Last year it was 17. The year before that was 16. Next year it'll probably be 19. I can give you a gift of $18,000. And when I give you that gift, I'm going to put it on my gift tax return. But I don't, even though I have to put it on my gift tax return, I don't have to pay taxes on it because I have a free exclusion. I can give gifts to anybody that I can give $18,000 to every single person in class and every single person that I know. Every $18,000 is excluded from me having to pay tax on. Okay, that's the exclusion. Anything over, if I give you $19,000, I'm going to be taxed on the $1,000. If I give you $20,000, I'm going to be taxed on the $2,000. A married couple can make a special election. So my mother and father, let's say they're going to give me a gift. They can both give me $18,000. Okay. Now, if I'm really wealthy and I'm giving out gifts like crazy, I have a lifetime credit of $13,610,000. It's a lifetime credit. Okay, that's used as the estate tax as well, right? So the credit for 2024 is $5,389,000, covers gifts up to $13,610,000. There's only one unified tax credit, applies for both taxable gifts and federal estate tax. It's the one unified gift. Okay. The credit for gifts is $5,389,000, which is included into the $13,610,000. Once the unified tax credit has been used up, any transfers will be subject to federal estate tax. So let's say I have all these gifts that I give out throughout my lifetime, and it adds up to the $5,389,000. Well, I've already used that all up. So my estate tax is now going to be the 13 minus the 5 million. So the value of the RV is not stated. So this is gift tax, but it probably exceeds the annual exclusion of 18 and 18 for the 2 donees and the 2 donors. 72 divided by 2. Need to do my calculation here. They have old numbers. Yeah, that's the 36,000. Equals divided by 2. Yeah, 18,000. So the mother and the father can do the gift splitting, right? To the two donors. So it's 18 and 18 to 18 and 18. So they had to do a gift tax return for the amount of anything over that. Okay. Income taxes, federal, state, and local governments. It's imposed on individuals using that rate schedule that we did over here. It's imposed on corporations, which is based on this 21% that we did over here. And the state and city, they have their own business tax rates as well. And then most jurisdictions ensure income tax by requiring pay-as-you-go. That's where your employer is withholding it from your check. And then they pay or let's say you're a self-employed person, you do estimated taxpayers. It's estimated taxes. Now, this is how the income tax works. It's income minus exclusions go into your gross income, minus the deductions, which are what I showed you over here, standard deduction or itemized deduction. But there's also other deductions, which we're going to get to in detail. Adjusted gross income, lesser of personal investments, itemized deduction, or the standard deduction. Okay, this less greater of, that's what this is. The standard deduction or itemized deduction. That gets you down to taxable income. Then you do your tax rate, which is that tax rate schedule that we did here. Minus any credits is your tax due or your refund. Okay. This is the 21%. That's corporate income tax. I already went through that with you. State income tax. Each state has their own type of income tax for individuals. There's different exceptions. Some states don't actually do that. The piggyback approach is that most states use the income determination for federal income tax as their tax base. So when we think about our federal return, the state piggybacks off of that, and their state return looks exactly like the federal return. And the state taxes you the same way the federal government does. Then we have some states that are different. They decouple from it, and they basically retain their own type of revenue, and they don't follow what the federal government does. That's decoupling, right? And then you can read more about the difference there for the state income taxes. Double taxation. Travis will need to review the state income tax laws in each state where he has clients, because his consulting company is doing work in different states. Well, if you have income and you're taxed on that income in one state versus another, you can't be taxed on all of the states for all of the income, because then you won't have any money left, right? So there's a way that you will look at the state income tax laws to see how the income earned in that state is taxed. And then your home state, let's say he lives in Connecticut, will provide a credit to negate the double taxation. So, cities, local income taxes like New York City, Yonkers, they have a local income tax, right? That's another tax you have to add to your whatever, your thing. So I'm going to, the employment taxes, FICA, taxes here. I want you to read all this. I'm going to go through as an example. Self-employment tax. I'm going to go through the FUTA, 6% on the first 7,000. And I'm going to show you that as an example in here. Okay. So payroll taxes. Okay. Let's say you get a job and you're getting paid, and your gross income is $10,000. Now, your federal, state, and city income taxes, I just put 10%, 7%, and 3%, just for something, right? And which works fine because it's under the 11,600. Okay. But if it was more than that, you'd have to follow this schedule to figure out what your taxes are. But I'm doing 10,000, which is less than the amount. So 10% is right. And 7% depends on the state, depends on the city. So what is employer taxes? The 10,000 is your gross income. Your employer will take out 10%, which is $1,000, and your employer will pay this to the IRS. Your employer will take 7% from your check, pay it to the state. Your employer will take 3% and pay it to the city. Again, these are just, they are correctly done. I don't know why I have that there. Okay. So now Social Security and Medicare, that's the FICA, which is in here. This is the FICA, 12.4 and 2.9. Okay. The 12.4 and 2.9. This is actually 6.25, okay, 12.4, 6.25, and 6.25 is 12.5. It's 6.2, it's 12.4 and 2.9. 145 and 145 is 9, right? So what happens is your employer will do 10,000 times 0.625, which will get $625 out of your check. Then your employer will take $625 out of their own pocket, their own checkbook. Take your $625 they took from your check and $625 from their pocket, add it together, $1,250, and pay this to Social Security on your behalf. Pay to the IRS on your behalf, pay to the state on your behalf, pay to the city on your behalf. But the employer, these are all payroll taxes, okay? And these are the employer parts of it. Your employer will also, for your Medicare, will take 10,000 times 0.145, $145. Your employer will then match that out of their own pocket, add it together to get $290, and pay this to Social Security for Medicare for you. Then FUTA, which is the next slide, the first 6,000 on first 6% on the 7,000, or and then there's SUTA. They don't show you about SUTA, but this is the federal unemployment taxes, and then there's the state unemployment taxes. So that's 6% of the first 7,000, and for SUTA, I'm putting 3% of the first 7,000. So your employer will take 6% of the first 7,000 and pay that to the federal unemployment for you. They'll also take 3% of 7,000 out of their own pocket and pay that to the state unemployment for you. So that means, like, if you lost your job and you go to get paid unemployment, you only get as much as what your employer put in for you. That's why people are like, well, why do I get paid such a little bit? Well, your employer only put in 6% of your first 7,000, so that's the most that you're going to get out of it. So this is your payroll taxes, which comes out of your check, but this is the employer part that comes out of their pocket. That's employment taxes. They're paying this on your behalf out of their own pocket. That's what that's describing. Okay. So back to the big picture. Presuming April and Martin might perform meaningful services for Travis, they're legitimate employees. April is not subject to Social Security benefit because she's under 18. To be able to do the Social Security benefit, this FICA stuff, you have to be 18. But 18 is, and he needs to be covered. And the law is, if you have someone 18 or over and they're working for you, you as an employer must put that money away for them. Amy Carter is an employee. She's subject to Social Security. Travis is an independent contractor. He has to do self-employment tax. So now think about this as This is Travis, and he's the employer, but he's paying himself. So he, as the employer, has his employer's bank account, and then he's got him as an employee. He's going to pay himself. So him as an employer, his company as an employer are going to do all this for him. He as an employer, it's going to go into his employment checking account, take this money out, and pay this to the Social Security and pay this to the federal government out of his employer book. And then as an employee, he's going to pay himself the $72.30. Now, as an employer, the good news is the employer is allowed to deduct, if he's self-employed, he's allowed to deduct, or she's allowed to deduct these employment taxes on his tax return. If we go to Schedule 1, again, IRS Schedule 1, there is a deduction here. Well, let me find it. Where did they move it for 2024? Deductible part of the self-employment tax. Now this Schedule 1 comes over to here. Adjustments to Schedule 1. So he'll get a deduction. For this part that he pays, this will be deducted on his personal tax return. So it's kind of like paying it and then getting a deduction for it. Other taxes, other U.S. taxes, federal customs duties. I want you to read about these. I'm not going to go over them. I want you to read about them. They're just telling you what types of taxes they are, okay? Occupational fees. Although the facts do not mention the matter, both Travis and Amy might owe occupation or license fees. Travis is an engineer, Amy for nursing. I'm a CPA. I have to pay my license fee. Every 3 years, I have to pay a license fee. That's what they're kind of talking about. Proposed taxes, a flat tax, a national sales tax, value-added tax, which is a VAT system where a lot of people from different countries, they pay VAT tax. I want you to read about these, but I'm not going to go over them in this presentation. Okay? And there's a knowledge check for you there. I want to get to the tax administration. So the IRS, the Internal Revenue Service, they are the ones that impose the taxes. The Department of Treasury is responsible for enforcing the federal tax laws. The Internal Revenue is appointed by the President with the advice and consent of Senate. The Commissioner is responsible for establishing policy and activities. The audit process. Only a small number of returns are audited each year using a mathematical formula and statistic sampling. And they'll just, based on that mathematical formula and statistic sampling, they will just pull it out. And then they're going to audit you. Or it'll be based on some things that seem highly irregular from your last year's return. The IRS will select a cross-section of returns. The IRS pays rewards to people who provide information leading to a discovery of people who violate tax laws. The reward may not exceed 30% of taxes or fines or penalties covered. So if you find out that somebody's not paying taxes, you can, have them audited. Correspondence audit, that's basically by a letter. An office audit, which means that the company is going to conduct it in the IRS office. They basically want you to come to their IRS offices with your paperwork. Or a field audit, which is when the actual auditor will come to your location. Those are the types of audits. At the end of the audit, either there's a refund, meaning that you didn't pay, you paid too much, a deficiency, you didn't pay enough, or there's no change, it was done fine. Okay. If the agent suspects fraud, if a special agent is coming with the regular auditor, it's because they suspect fraud, and you should get legal counsel to represent you. If an audit results in an assessment, meaning you have to pay taxes and there's no settlement reached because we're arguing, I don't owe it. Yes, you do. Blah, blah, blah. You can request an appeal. The IRS says, here's the audit. This is what we think it is. You can request an appeal. You can have an appeal with the Independent Office of Appeals to the IRS. You can fight it. Okay. If you are not satisfied with the outcome here, you can take them to tax court, federal tax district court, and court of federal claims. Litigation is recommended only as a last resort because it's going to cost you money to do it, and you are uncertain of the final outcome. So the IRS audit that we talked about, the Walkers, they got a correspondence type, which was just a letter that they dealt with it, which might be an oversight. The Carters were more serious. It was a field or office type. You can read that. Statute of limitations. Statute of limitations means that the IRS or any governing body can come after you for whatever crime it is, but they have a certain amount of time to come after you. So every single crime has a statute of limitations attached to it, meaning that if somebody committed this crime, they have to be brought to justice, brought to the court system, or arrested and brought to the court system and found guilty by that time frame. So it's a provision that any lawsuit to be brought within a reasonable period of time. So if I basically filed my tax return in 1999 and now it's 2014 and they want to do an audit, I don't have those books and records. I don't have that information. It's not a reasonable period of time. You can't go back that far. So each type of law has a certain time frame of when the lawsuit can be brought up. There's two, for federal income tax purposes, there's two categories: assessment of additional tax by the IRS and time limits. So if there's a deficiency assessment by the IRS says you did not pay enough taxes, you owe us money. Well, generally they have time, they have 3 years from the due date or the filing of the return. So I'm supposed to file my return on April 15th. But if I got an extension to October, it's 3 years from October. That's when the IRS can come after me, 3 years from October. Or if I have omitted more than 25% of my income, the time period is now 6 years from the date of filing the return. If a fraudulent return is filed, there's no statute of limitations. They can come after you anytime. For a refund, if I'm claiming a refund, I have 3 years from the date the return was filed, or 2 years from the date that it was paid, whichever is later. Interest and penalties. I told you before that if you didn't pay your money timely, that I said you owed 1,000, but you only paid 900, and you did it in 2022. And now, I don't remember the year I said before, let's say it's 2022, and now it's 2024. If it's not received within 45 days, there's an 8% rate charged on that amount. So 8% of 100. Okay, and that rate is changed, and it's published quarterly. It's changed every quarter. Now, if you have a failure to file your tax return by the due date, the penalty is 5% per month, up to 25% of the amount of tax shown on the tax return. Any fraction of a month, 1 day is considered a full month. So 1 day of that month, so let's say it's January, February, and 1 day in March, that March is full month. Failure to pay the tax. So failure to file your return by the due date is 5% of what you owe. Failure to pay the tax is 0.05% up to 25%. And again, negligence is up to 20%. And then there's various penalties. If it's a civil fraud, it's a penalty of 75%. If it's criminal fraud, it could be large fines as well as prison sentences. Negligence penalty is not imposed. Okay, so there's some knowledge checks there for you to look at. Tax practice, you can read this. There's different types of tax practices. The ethical guidelines by the AICPA. They're going to have questions on the test on this. Statutory penalties on a tax return preparer. If I am a person who prepares tax returns, there's going to be penalties on me if I understate. I say the tax liability is less than what it's supposed to be. If I willfully attempt to understate the tax, if I fail to exercise due diligence and the eligibility for this. So let's say, for example, I put on someone's tax return a tax credit, a child tax credit, and all of these credits to lower their taxes, but they don't even have a child. That's, I didn't do my due diligence to find out how many children do you really have. If they say I have 5 and they only have 2, did I do my due diligence to see that they really did or they didn't? So, I have to make sure that I provide a copy of the return to the taxpayer. Failure to endorse a taxpayer's refund check, right? So I will have penalties on me if I fail to do any of these things. There's a thing called a PTIN, a Preparer Tax Identification Number. I'm a preparer. They are required for a tax preparer of most federal tax returns. All persons who are paid for preparing or assisting in preparing these returns, I should have a PTIN. Okay, and there's some knowledge checks for you there. All right. Understanding the tax law. Again, I want you to read this. Why do we raise revenue? What's the economic considerations? Federal tax, the social considerations, the equity, the political. I gave you some examples at the beginning of the chapter, at the beginning of this. What's the influence of the IRS against collecting taxes? What's the influence in courts? And there's some knowledge checks there for you. The IRS is the protector of revenue. Okay, the IRS wants people to pay their taxes, and they also have to look and make sure that they got to change the taxes here and there if they see that people are exploiting a tax loophole. Then there's the courts, okay? The courts will, if you are upset about something and you bring the IRS to the court, it's going to create case law. It's going to create changes in the law based on changes in your case. And there's your knowledge check. Back to the big picture, okay? The difference between the ad valorem taxes is a value in your house or the value dropped of your house, or maybe that they were older and they became retired, which gave them more of a deduction. The use tax, because he bought the automobile in a different state and brought it to New York, which is taxed, they have to now pay the sales tax. Gift tax between family members, there's a limit. Anything above that limit, you have to pay taxes on. The Carters must recognize some of their income in 2 states and take advantage of whatever relief is available. The employment by their family, their children, is fine and it's good. The Carters should be assured that, make sure that they pull out the Social Security tax and withholding for their son, but they don't have to do it for their daughter. Because of the 2 audits, the tax, they want to make sure that they don't make those mistakes in the future. Okay, so if you have any questions, again, I'm going to take this Excel file. I'm going to change this now to 18,000. 18,000 because this used to be 16,000 last year. That's your 72,000 that we talked about, right? Amy got a gift from mom for 18,000. Amy got a gift from dad for 18,000. Travis got a gift from mom for 18,000. Travis got a gift from dad for 18,000. So the tax, let's say that this is worth $78,000. That's the value of the RV. Well, 72,000 is tax-free. So $78 minus the 72, 6,000 is taxable. Okay. So if you have any questions, you can email me and I will make sure that I set up a time